Derivatives are very peculiar financial instruments because they're entered into at little or no cost. But their value is derived from the price of an underlying item. So futures contracts, forward contracts, option contracts take on a value as interest rates rise and fall, currency rates rise and fall. They're designed to be settled at a future date. Now, derivatives must be at fair value, because if they are at cost, they are effectively invisible and they're not accounted for. We would have incomplete if we use cost. We would have unrecognized gains and losses if we use cost. So derivatives are a good example of when we use the fair value model. If the reason for using the derivative is speculation, which is your default, then you take the gain or loss on the derivative to P&L. If the reason you're using the derivative is insurance, is cover, is part of a risk management process, then where you take the gain or loss depends upon the nature of the risk that you're covering. If the risk that you're covering, the hedged item, throws up a gain or loss in this year's P&L, take the insurance to this year's P&L. Have a match in this year's P&L. If, however, the gain or loss on the hedged item does not appear in this year's accounts, you've got to carry forward that gain or loss on the derivative in OCI. So you can then effectively recycle it back to the P&L at a future date. It's all about the substance of hedging, pairing. It's all about the substance of hedging, offsetting. If you can do the offset today, the hedged item and the hedging instrument, it's a fair value hedge, and that is what you do. But if you can't match the gain and the loss, if you can't offset, it's a cash flow hedge and you carry it forward. And the inventory, that the loss was not mentioned in the accounts for the inventory, the fall in the value from 12 to 11, because we kept it at 9, so it was a cash flow hedge on a future transaction. Page 58. I think you need to read it. I think you need to read it first. Explain and illustrate the accounting of the above transactions. So our year end is 30 September. All right? A few weeks ago, in July, 2.5 months ago in July, we sell goods to a foreign customer. Now the transaction is in krona. We are functioning in dollars, of course, so this is a foreign currency transaction, individual company stage. The transaction would be translated at spot. So we will debit and credit our debtors and our revenue at the spot rate. The customer is going to pay us 6 months later. We are going to receive the krona 6 months later. We now have an exposure to foreign exchange risk. Because if the exchange rate goes against us, we end up receiving less money. Mind you, the exchange rate could go in our favour and we could end up with more money. If we hedge to eliminate the risk, we hedge to eliminate the reward. You create certainty. So what we do on the same day is we enter into a contract to sell the 40 million kroner for exactly $23 million. So we eliminate the risk. We have a risk management strategy. Now this contract is entered into at no cost. It's designated as a hedging instrument. It's not speculation, it's definitely a hedge. The currency fluctuations are such that at our reporting date, this currency contract, which was entered into at no cost, is now an asset of 1.5 million. Hooray! We have an asset. But presumably the reason that we've got an asset is because there's been a retranslation of the debtor, and the debtor, the foreign currency debtor, has basically shown a loss. So the draft accounts do not include any amount in respect of the derivative. The draft accounts do not show any amount in respect of the currency contract because it has a zero cost, but the draft accounts do recognise the exchange loss on the retranslation of the debtor. So, before we get to the punchline, let's build up our story, let's build up our marks. We have a foreign currency transaction. We have a foreign currency transaction which will be translated at the spot rate on the 15th of July. At the year end of 30 September, we have a monetary balance in the form of a receivable which is retranslated at the closing rate. Where does the exchange or loss go? We've got here a loss. So there is a loss of 1.4. Where does that loss of 1.4 go? If it's at the individual company stage, your foreign currency exchange difference goes to P&L, yeah. So if it's at the individual company stage, the exchange difference goes to P&L. I start with the easy stuff, the foreign currency debtor. Transaction is at spot, monetary balance is at closing. The currency contract is a derivative. Currency contract is a derivative. It's a financial instrument that has been entered into at little or no cost, whose value is derived from the price of an underlying item, and is designed to be settled at a future date. Must be at fair value, and it's a hedging instrument and there is a gain of 1.5. This is the punchline. If it was speculating, P&L. It's not speculating, it's hedging. If it's hedging, you, at worst, have got a 50-50. If you've got no idea, you've just got a 50-50. The idea of hedge accounting is to pair. The idea of hedge accounting is to offset. The idea of hedge accounting is to match. With the inventory, we couldn't match, so we took it to OCI. Where do you want me to take this gain to? P&L or OCI? Is there a loss in the P&L, yes or no? Yes, there is a loss in the P&L. And because of the loss in the P&L, and we've hedged that loss, we've insured that loss, we've covered that loss, because the loss is in the P&L and it's been insured and covered and hedged, we want to take the gain on the derivative and put it in the P&L as well. The hedging instrument is a gain of 1.5. This is a fair value hedge. We can match in the P&L. This is a fair value hedge. We can match it in the P&L. This is a fair value hedge. We can match it in the P&L. So in the profit and loss account, you would have both the loss of 1.4 and the gain of 1.5. Not a perfect hedge. Something called basis risk may have crept in. It's not a perfect hedge, but it is substantially covering the risk. This morning, no, not this morning, yesterday, we did group profit and loss account and OCI, and I have seen exam questions where for, I think it was 1 mark, 2 marks, you were told, oh, we have a derivative, there's a gain or loss, we're not sure where to put it. And then you had to, I think it was a cash flow hedge, and you just put it in OCI. And, you know, there's 1 mark, 2 marks available for that. But if you had to write about it, there would be a little bit of thinking to do. Excellent. Right. Let's go back. Let's have a little play with. Let's have a little think about what's going to happen with held for sale, discontinued operations. So just a little hurrah on IFRS 5, which I don't think we've covered. Have we covered IFRS 5? No, but we are going to cover it. It is an important standard. So I do want to cover IFRS 5. And here we are thinking about IFRS 5, and I think that means we have to refer back to part 2